Thanks for watching this latest global market update where I speak to Glen Bertram, who heads up portfolio management and asset allocation. And we discuss some of the key themes that he's keeping an eye on at the moment and the way that geopolitical risk has become structural. He's also talking about the things that he is looking at most carefully when it comes to artificial intelligence at the moment. And there's also some emerging opportunities that have shaken out of the most recent volatility that are worth looking forward to at the end of the video. Glen, you have just written quite an expansive note about some of the factors that you see as being the key risks or things to navigate in the markets. And amongst those, you spoke about geopolitical risks being elevated, but they're on the cusp of becoming structural now. So does that mean that we're at the risk of embedding some pretty significantly higher inflation expectations?
Yeah, I think that's one outcome of it. I think what we're referring to there in our work is the market's attention is clearly focused on one major geopolitical risk that's front and center right now, which is what's happening in the Middle East conflict. And broadly speaking, I think our view would be that markets are assuming a fairly benign outcome relatively quickly as we screen this right now. But even if that's resolved quickly, I think there are still a number of other issues that are out there, including Ukraine, which is still going on, the Taiwanese issue, domestic political issues in many different countries. So I think the point of what we were writing about was even once this resolves, I think we're in a more structural environment of kind of rolling conflicts that investors need to pay attention to. And a lot of them, it turns out, probably impose pressures on inflation and the inflation outlook.
We've, in previous conversations, spoken about tail risk. So that now seems like we're in that fat tail scenario. Is that the base case that you're using in your thinking?
No, not so much. It's actually an interesting point, Tom, because I think at the time that we're recording this, equity markets, for example, are back at all-time record highs. So I think you can only infer from that consensus expects this particular conflict to resolve relatively quickly. But clearly, in our view, we think the downside tail risks are fatter. I mean, it doesn't sort of take a genius to realise that things could go wrong, here and in some of those other issues that we talked about. And I don't think as investors we should be attaching, a probability of zero to them, and probably not even a trivial probability either. So we're all about building portfolios, investment portfolios that can be resilient to a wide range of outcomes, including those tail risks.
Do you think it's reasonable to say that the market is mispricing risk at the moment? And I know the old adage, the markets can stay irrational for a lot longer than you can stay liquid, but it just feels like, as you point out, equity markets at record highs, the risk premium in interest rate markets seems pretty slim at the moment. This could all sort of go a little bit pear-shaped, couldn't it?
It could. I mean, I would say there are two big issues there to understand and be thinking about. So, first on the oil price trajectory, and we know, by now we're very aware that it has big knock-on effects to economies and economic growth. Until really just a couple of days ago, the market was assuming that oil prices, the forward prices, were going to come all the way back below $80 in only a few months. That's pretty optimistic, I think, in our view. So in our view, even if the conflict resolves tomorrow, we're still going to have disruptions, meaningful disruptions to supply likely for several months. I guess we would characterise that forward curve as pricing in as a base case quite a favourable outcome. So no doubt there's some risk there. But then maybe what the equity markets are saying, if we kind of take the message or take the cue from markets, is that actually major markets and major corporates in those spaces are more resilient to energy shocks and higher prices than what some commentators might perceive. And then coupled with that, if we look at the biggest component of global markets, for example, being in the US, the fact of the matter is earnings revisions have been very good, have been very strong. So that's allowed the market to, go back to record highs at the time that we're speaking, and actually pull the forward PE ratio down a little bit. It's trading about 21 times forward now. Let's be frank, it's still a big number by historical standards, but it's not the highest that it's been in recent years. And the big drivers of those earnings, those strong earnings performance, have obviously been energy companies. We know what's driving that, but also the IT space, and particularly upstream AI beneficiaries in memory, semiconductors, Nvidia, Micron, and other companies like that. So there have been earnings that have gone with it. It's not totally without foundation.
Is it reasonable to say that this current earnings season, which has been going so well so far, is it slightly dated though, given everything that we've just spoken about?
Yeah, I think it is a little bit. And so we're pretty laser focused now on cyclical companies and industrial exposures to the outworkings of what we were talking about before. So there will be impacts on some corporates. But I think when you slice the markets up and where the big sources of market cap are in terms of major benchmarks and also earnings, a lot of that is probably pretty resilient to what's going on in energy markets outside the direct energy sector itself, which is relatively small. So that's all about the big spending plans of these hyperscalers and others on AI equipment and all the beneficiaries of that, which is really driving their earnings and overall market earnings very significantly.
You actually make a very good point around that in your note, that the hyperscalers, with the eye-watering sums that they have invested over the last couple of years and what they're still going to invest in the next couple of years, that 27, 28 calendar years become very important for those organisations in terms of delivering on those extraordinary investments.
Yeah, I think so. Yeah, so thanks for sort of raising the point. So, this year we're talking $600 or $700 billion against just those four major cloud companies, hyperscalers. Next year, probably similar magnitude, maybe even a bit higher. And what's happened is those business models, they're such enormous index heavyweights. They've moved from a capital light model where they were generating enormous cash flows to a position now where as a group and certainly some of them are not generating much or any free cash flow. So the market's giving them a pretty big hall pass for a while to demonstrate that these investments will be profitable and will generate cash flow. But yeah, come 27, I think the market's going to want to be seeing that in the near term. Yeah.
It's not a novel thought by any measure, but the parallels with the turn of the century are impossible to ignore. Like, what are those first signs that you look for where you go, you know what, this is just a little bit too optimistic the way things are taken shape in recent times?
Yeah, so maybe first we deal with the clear difference. So the clear difference that I think we need to, you're obviously referring to the tech crash and the 98, 99 experience. I think the clear difference that we have to put on the table this time is that the majority of the companies that are involved in the investment boom are very well funded, have enormously profitable cash flow generative existing businesses. That was not the case with what was going on in 98, 99, and the valuations off the back of that, conventional valuations, are much lower this time around. The similarities and the pause for thought and the concerns, I think, revolve around the progression of financing, the slow progression of financing away from cash and operating cash flow to now a position where even the most liquid of these companies are starting to draw on debt, which kind of ups the ante, and we've also got this time around in some parallels major private companies that are making substantial private capital commitments that we know are dependent on pending IPOs, which will be required to refinance a lot of debt and bridge financing that's being put in place. I'm talking specifically about recent deals with private majors like OpenAI and Anthropic. So we're hurtling towards a point where more capital will be required. We know that, and the sums are very large, and we're just all not quite sure where it's going to come from.
And you've also written about how the fact that the net asset values of private investments are beginning to reflect that caution that's been expressed towards investors and the way that money's being deployed into the AI space.
Yeah, so there's sort of a few different issues going on here, but basically the nexus between private markets and what's playing out in public markets is being joined a little bit through what's going on in AI more broadly, and then just the really significant and central role that these two private behemoths in the model building space, so OpenAI and Anthropic, so the makers of ChatGPT and Claude, are sort of filling and telling us that they intend to become public at some point over the next 12 months. So that's appearing in a lot of different areas in private markets that are maybe giving us a window into where some of the early cracks are and things that we need to be paying attention to. So, we wrote about, and one of the big things now, and you don't have to look too far in terms of publications to see that there's quite a bit of concern in private credit at the moment. A lot of that's related to liquidity and some vehicles that were put in place to provide investors with some level of liquidity where the underlying was fundamentally illiquid, which causes some issues. But what's driving a lot of it is just exposure to underlying software and technology that is changing, where business models are changing rapidly. It's the same in other core parts of private markets where there are significant investments in particularly software businesses, in private equity and venture capital. So we're dealing with an outlook now where we know in the listed space, so major US listed software as a sector has halved from its peaks last year. So it's one of the sectors, against a market that is trading at all-time record highs, it's one of the sectors that's way down. And then we've got really significant exposures over in private markets, some of which are coming to market over the next 6 to 12 months. So we're just watching really carefully to see how that all unfolds and what investors' appetite is to fund, to fund these different companies at what valuation. Yeah.
I mean, you say you're watching carefully. Is there a particular canary in the coal mine? Is it corporate bond spreads? Is it something in particular that's going to give you that early heads up about things just looking a little bit different?
Maybe if we're looking for canaries in the coal mine or really significant pending events, they're probably not the headlines and what's going on in private credit. They're probably more just pending valuation adjustments that sort of seem like they ought to be coming in some of the space that sits behind those senior ranking claims in the equity. But actually, I think the biggest thing to watch and the biggest canary is we've got 3 absolutely monster deals or IPOs coming to market in the next 6 to 12 months. So we've got the SpaceX IPO at a mooted 1.75 trillion with a T, and then OpenAI at maybe another trillion, and Anthropic at not much less. They are just 3 absolute whoppers, and there will be significant new capital raised as part of that, and that's going to suck a lot of liquidity out of the market. So the sort of test run, it looks like SpaceX will come first just to see how that goes, what it gets done at, how it trades. That's going to be, I think, important for the trajectory of markets around those events and beyond.
Just reflecting on the performance of the local market, under the circumstances, we did reasonably well in the last quarter, and the Australian share market's been spoken of in terms of its defensive qualities. Something that hasn't been defensive at all has been the performance of the local healthcare sector. You know, to see names like CSL and Cochlear down to the extent that they're down at the moment. I mean, you know, these are organisations that have been the bluest of blue chips in recent years. Does that speak to something else that is happening that perhaps investors haven't been able to get a hold of in the last 18 months, for example?
Yeah, maybe. I mean, maybe the first thing to point out is the Australian market's been pretty resilient through this recent conflict, but also for the last 12 or 18 months, principally because it's dominated by banks and mining companies. So resources and broader financials are probably indirectly 60% of our market. Bank valuations have been really strong and operating conditions have been fine, been okay. And the major miners have had really material upgrades driven by favourable commodity price trends. So the bulk of the market has been very solid, the bellwethers. But as you point out, there's been a lot of money that's been sitting in so-called defensives in the healthcare sector. And we saw a couple of days ago what can happen when expectations are not realised, and this just seems to be the new way markets operate now. When companies downgrade, where earlier on in my career, if a company might have fallen 10-15% on a more balanced assessment, of near-term operating conditions, it just seems to fall 20, 30, 40 just really quickly. Now there's a whole bunch of reasons for that in terms of the players in markets and who's driving that, but yeah, it just I guess it just evidences the point for investors that a company is not necessarily defensive by virtue of the sector that it sits in. It's defensive because it has defensive earnings and it meets investor expectations on them. So, especially given the conflict we were talking about and the risks around it, I think my colleagues are on pretty high alert for upcoming trading adjustments and trading announcements, and making sure that the market is reasonably priced and reasonably familiar with the likely operating conditions that could be changing in the next 3 to 6 months.
Something that's also being repriced a little bit is the Aussie dollar. So there is considerable upside risk, I suppose, to forecasts at the moment. How significant a factor is that in your thinking at the moment?
Yeah, it's really important. It's crucial. I mean, if you're investing offshore, as a lot of our clients do, and the Australian savings system in general does, we've outgrown our domestic market, then currency impacts are very important. The decision whether to hedge or not. Obviously, the Australian dollar has risen a lot over the past 12 months. It's still trading. If you looked at the difficulties in March, it still tried to sell off a little bit when conditions got tough. So it's still got that kind of relationship where it wants to try and fall when equity market conditions are difficult and rise on the on the other side. But I think our point is that versus historical relationships, the magnitude of those falls were really quite small. It's been, as you suggest, very robust for quite a while. And I think that's because the Australian economy is holding in okay, and because of the position the Reserve Bank's taking and the likely trajectory of interest rates. So, so in the local market, the bond market currently expects another couple of hikes. From here, I think by September there's another two hikes priced in. That'd take the cash rate up into the mid-4s, whereas conversely, over in the US, for example, the market's expecting no change for the foreseeable future, and incoming Fed Governor Kevin Warsh has basically just given the nod in recent comments to that pricing. So, you're looking at a situation going forward where you probably got upward pressure on domestic rates, domestic cash rates, no such upward pressure on US rates. Our rates are already higher and going higher. That's why there's a fair bit of upward pressure on the Aussie dollar.
Glen, when it comes to crises, it's really important not to let them go to waste, because inevitably, amidst the wringing of hands and gnashing of teeth, there'll be an opportunity. Is there any particular area that you see at the moment as perhaps flashing in that regard?
Yeah, certainly. I mean, equity markets, as we spoke about, are at all-time record highs. But against that backdrop, the backup in local rate expectations is giving plenty of investors the opportunity to invest in a lot of direct bonds we're seeing at 6 to 7% per annum. Yields now, total returns that are in very high grade corporate offerings, very low risk, so that's attractive. And similarly, all the spending that we spoke about that's going on in AI, there's no let up to it. And there are many infrastructure companies, including utilities, that are vending into that strong spending pipeline that look really robust and are still not trading particularly expensive and offering really good stable yields. So they'd probably be the two key call-outs for us.
Glen, it's always good to talk to you. We never seem to have enough time. Thanks for your time.
Thanks, Tom.
And thanks for joining us.